Investing in small apartment buildings can be a fantastic way to build wealth, but it's not just about buying right, it's also about knowing when and how to exit. Understanding your exit strategy from the beginning is crucial for maximizing returns on your investment. Let's explore 3 primary exit strategies for apartment investors: selling, refinancing, and long-term holding. Selling your apartment building is the most straightforward exit strategy. This involves listing your property on the market and finding a buyer willing to pay a price that meets your investment goals. Selling allows you to realize any accumulated appreciation in the property's value and walk away with a lump sum of cash. Refinancing, on the other hand, allows you to tap into the equity you've built in your property without selling it. By refinancing your mortgage, you can potentially lower your interest rate, reduce your monthly payments, or pull out cash to reinvest in other opportunities. This strategy is beneficial for investors who want to continue owning their property and generating cash flow while accessing some of their equity. Lastly, long-term holding is a strategy where you plan to keep your apartment building for an extended period, typically 10 years or more. This approach focuses on generating consistent cash flow from rental income and benefiting from potential property value appreciation over time. Long-term holders often use this strategy to build generational wealth and secure passive income for the future. Each exit strategy has its own advantages and disadvantages, and the best choice for you will depend on your individual financial goals, market conditions, and risk tolerance. In the following sections, we will delve deeper into each strategy, examining their potential holding periods, objectives, and estimated returns. Determining the ideal holding period for your apartment investment is crucial for maximizing returns and achieving your financial goals. While there's no one-size-fits-all answer, let's explore common holding periods and how they align with different investment objectives. A short-term holding period, typically around 5 years, might suit investors seeking quick capital gains. This strategy involves strategically improving the property and selling it when the market is favorable to realize a profit. However, it's essential to factor in transaction costs, capital gains taxes, and potential market fluctuations that can impact your returns. A medium-term holding period, such as 10 years, offers a balance between capital appreciation and cash flow generation. During this period, investors can benefit from mortgage principal paydown, potential rent increases, and gradual property value appreciation. This strategy can be suitable for investors seeking a combination of short-term gains and long-term wealth building. Long-term holding, exceeding 15 years, focuses on building generational wealth and securing passive income for the future. Over an extended period, investors benefit from substantial mortgage amortization, potential property value appreciation, and inflation-hedged rental income. This strategy requires patience and a long-term outlook, but it can be highly rewarding for those seeking financial security and leaving a legacy for future generations. It's important to remember that these are just general guidelines, and the optimal holding period for your investment will depend on several factors. Your financial goals, risk tolerance, market conditions, and property-specific factors all play a role in determining the best time to exit your investment. Understanding potential returns is crucial when evaluating different exit strategies for your apartment investment. While predicting the future of real estate is impossible, we can use some key metrics to estimate potential returns based on different scenarios. Let's start with selling your property. To estimate sale proceeds, you need to determine the property's future market value. This involves researching comparable properties in your area, considering market trends, and factoring in any planned improvements. Once you have an estimated sale price, deduct selling costs like realtor commissions, closing costs, and any outstanding mortgage balance to calculate your net proceeds. Next, we can calculate the equity multiple, which reveals the total cash returned relative to your initial investment. Divide the total cash returned, net proceeds plus any cash flow generated during ownership, by your initial investment. For example, if you invested $100,000 and received $250,000 back, your equity multiple would be 2.5 times. Another essential metric is the internal rate of return, IRR, representing the average annual return earned on your investment over the holding period. Calculating IRR considers the time value of money and provides a more accurate picture of your investment's performance than simply looking at the total profit. By estimating these metrics for different exit scenarios, you can compare potential returns and make more informed decisions about when and how to exit your apartment investment. Remember to adjust your calculations based on market conditions, anticipated expenses, and your desired investment returns. While having a well-defined exit strategy is crucial, successful real estate investing requires flexibility and adaptation to changing market dynamics. External factors such as interest rates, economic conditions, and local market trends can significantly impact the optimal timing for exiting your apartment investment. Regularly reassessing your exit strategy is essential to ensure it aligns with your financial goals and current market conditions. Stay informed about local market trends, analyze comparable property sales, and monitor interest rate fluctuations. This information will help you identify potential opportunities and adjust your strategy accordingly. Performing sensitivity analysis can help you prepare for unexpected events and market shifts. This involves testing different cap rates, adjusting for potential income and expense changes, and evaluating how these factors impact your overall returns. By considering various scenarios, you can make more informed decisions and mitigate potential risks. Remember that tax implications play a crucial role in your exit strategy. Consult with a tax professional to understand how capital gains taxes, depreciation recapture, and other tax regulations might affect your net proceeds. Planning for these implications in advance can help you maximize your after-tax returns. Finally, be prepared for contingencies. Holding on to your property longer than initially planned might be necessary if market conditions become unfavorable. Having a contingency plan in place, such as refinancing to access equity or adjusting your rental strategy, allows you to navigate unexpected challenges and emerge from your investment successfully. By staying informed, remaining adaptable, and seeking expert advice, you can position yourself to make informed decisions throughout your investment journey and maximize the return on your apartment investment.